This is the Asia Trade. I'm Haidi Stroud-Watts in Sydney, where markets have just opened.
And I'm Avril in Hong Kong. The top stories this hour. Asian stocks set for gains after Wall Street edges higher despite a fall in U.S. consumer confidence. Oil in focus as Ukraine and Russia agree to a truce in the Black Sea.
We're live at HSBC's Global Investment Summit in Hong Kong, speaking exclusively with their global head of markets and the CEO of corporate and institutional banking.
And I'm Paul Allen at Parliament House in Canberra, where the Albanese government's just delivered a pre-election budget featuring surprise tax cuts, also rebates to address voter concerns on cost of living. We'll be speaking with the Finance Minister, Katy Gallagher, and also get the opposition response from Shadow Treasurer Angus Taylor.
And I'm Stephen Engel in Hainan, southern China at the annual Boao Forum for Asia. We'll hear exclusively from the chief operating officer of China's #1 smartphone maker, Vivo, about reviving the Chinese consumer sector and, of course, navigating Trump's trade war.
Those trade war concerns never far from investors' minds, but take a look at how we're setting up when it comes to the start of trading here in Asia this midweek session. Looking like we'll see some nice gains after the US stock market rose for a third day. It was really kind of a late session rally, though, in big tech that helped support the US benchmark eke out that third session of gains. We are seeing a little bit of upside as we just creep online with that staggered open here in Australia. The ASX 200 up about 0.2%. As Paul mentioned, we saw the unveiling of perhaps some surprising pre-election tax cuts, some other sweeteners to address voters' cost of living concerns and also help Prime Minister Albanese potentially secure that second term in office. We saw that recording that deficit of $42.1 billion in the year through to June 2026. So seeing how individual sectors in particular reacted, that there was an extension of an energy rebate that could be something that moves markets, as well as increased spending on healthcare and infrastructure. So those are some of the sectors we're watching for in the Sydney session. We're also seeing some upside when it comes to Chicago Nikkei futures at the moment. Dollar yen just shy of that 150 level. We did see that weakness in the greenback overnight against most G10 currencies. We saw US consumer confidence dropping in March, the lowest in 4 years, amid the ongoing concerns about the trade war. I'm continuing to watch the Aussie there as well, seeing a little bit of a lift with that tax cut announcement and some of those rebates that were announced in the budget, Avril.
Indeed, and as we watch for how the market continues to react to that, take a look at how U.S. futures are shaping up, maybe an extension of gains despite the tariff uncertainty and despite some of these economic indicators really pointing the wrong direction, right? You look at U.S. consumer confidence, given the tariff overhang, how that's fallen to the lowest level since early 2021. That really is a concern for consumers, and that, I think, continues to play out in some of the caution that we're seeing in the bond markets. Certainly, we saw that slide overnight on the U.S. 10-year futures continuing to point in that direction. Now, all this tariff uncertainty, though, is creating some sorts of opportunity. If you take a look at this next board, it'll show you that arbitrage opportunity. U.S. copper futures, they vaulted to a record high. This disconnect, right, with the London contract, that's something that we saw really developing in January, and over the past couple of months, that spread has just widened as traders perhaps price in potential tariffs on the U.S. side of things. And in the meantime, as we weigh out these geopolitical concerns as well, take a look at how crude is shaping up. We saw it kind of snap a winning streak, and I think this was its longest winning streak in about 3 months. It looks like it's pointing higher despite the odds rising of this Black Sea truce, it seems.
Well, there's a lot going on this week, Avril, of course, and Hong Kong is one of the epicentres of focus, where we have the HSBC Global Investment Summit continuing into a second day, and our very own David Angus is there again this morning and joins us now. And Dave, you spoke exclusively to the bank's CEO about what progress has really been made on these sweeping restructuring plans.
Yeah, and I think the takeaway from that conversation. Good morning, guys, by the way, and thank you for having me on your show and giving me some space here. Yeah, I mean, the takeaway I think from that was really the pivot and refocusing back to growth areas of strength at the bank, obviously where we're sitting here in Hong Kong is key to that as well. So we are entering day 2 here. You guys are coming to me about an hour early than you guys did yesterday, so there's nothing for me to say in terms of a scene setter. I mean, I can see some people struggling to get the coffee machine open, but apart from that, I think when we talk about things a bit later on, things are going to be buzzing a little bit further. But again, enough of what's happening here, enough of me. Let's play that soundbite, in fact, for our viewers, right? Just to remind them really of the setup going into day 2.
Obviously, we want to double down on all our capability around debt. That's debt capital markets, leverage acquisition finance, and other financing activities, because that's the heart of everything we do globally. And in regards Asia and the Middle East, we want to also double down our capabilities in M&A and ECM.
And joining us here on set is Patrick George, Global Head of Markets and Security Services at HSBC. Good morning and very nice to see you.
Good morning, David. Thank you for having me.
Yeah, I hope you guys had a nice rest. It was a very busy day yesterday. The CEO, we just played that soundbite out for our viewers. We'll talk about that, what that means for your business specifically. My colleagues in the studio just talked about this, copper in the US, for example, is catching a very strong bid, this tariff uncertainty. Risk assets can't seem to gain any decent momentum going into, a couple of weeks. What do you think is going on? What does the outlook look like?
Look, there is no doubt about it that the geopolitics and the tariffs are today driving monetary policy, fiscal policy, and also the moves on asset, any asset, whether it's copper or any risk asset, more specifically foreign exchange and rate, and the equities. And I do believe that investors are reassessing the parameter of this new global equation that is driven by the geopolitics and the tariff. And I do believe also central banks, if you look at the Federal Reserve, they're trying to reassess where are we. Have we entered this new danger zone of lower growth and inflation, stagflation? I'm not saying there is one, but definitely we are reassessing. And I think investors, whether they are institutional, corporate, or wealth or retail, are completely reassessing this new equation to understand exactly where we are heading. So yes, there is question mark out there, there is volatility out there, and all valuations are being reassessed at the moment.
What is this new equation? What's the paradigm that HSBC is using to at least try and reorganize all this information?
Look, the world order as we've known it is changing. There is a new world order out there. And I wouldn't say it's the end of globalization. By all means, no. What we're seeing is a redefinition of globalization, a re-globalization. We're seeing new trade, new corridors of trade. We're seeing new corridor of trade between China and Southeast Asia, between China and the West, between India and the West, between China and the Gulf countries. Those new corridors of trade are impacting finance and are impacting assets, are impacting foreign exchange currencies, are impacting companies. Companies are trying to reestablish how they're going to invest. What is the future? And I believe investors also are trying to reassess the value of those new corridors in order to decide where they invest, whether it's in the foreign exchange, in the fixed income business, or in the equities business.
Yeah, we were talking just before we started, and the word uncertainty featured quite a lot in a lot of the discussions on stage and here around the set yesterday. How would you compare the level of uncertainty that markets are going into right now? Is there a comparable episode in the past that we could use as a good analogy to what's going on?
One thing we heard over the past 2 days at the Global Investment Summit is the word uncertainty. The only predictable thing is unpredictability. Right. That is no doubt. Look, compared to the past, I don't think we have a crisis as such. We don't have a stress in the system. We don't have the same impact we had during the financial crisis or during COVID. We're not seeing that kind of environment. What is for sure, there is a lot of uncertainty about policies. There is a lot of uncertainty about monetary policies, about fiscal policy going forward, and that is impacting volatility. If I look at the flows we've seen year to date, there is definitely an increase in flows in all the asset classes in our businesses, and whether it's coming from corporate institution or from corporate client or institutional client. No doubt about it. A lot of uncertainty going forward. We're going to witness volatilities, but we don't have a stress in the system in the same way we've seen in the past.
Have you seen a pronounced pickup in client flows into fixed income and rates and FX, for example, in recent days?
By all doubts, we've seen a big move in volatility in foreign exchange for sure. Right. Tariffs will impact foreign exchange. Tariff uncertainty will impact the US dollar moves. So for instance, we've seen a big movement in emerging market currencies versus the US dollars. We've seen big movement in the rate business also because of the uncertainty of the Federal Reserve move. So no doubt about it, we've seen volatility, we've seen flows year to date.
Can markets at least make the assumption that in 12 months' time, rates will be lower and not higher?
Look, our basic assumption is that the Fed will cut rate in order to normalize a little bit, given the slowdown we're seeing in the U.S. economy. I don't think there is evidence of a recession at the moment, but it's definitely a evidence of a slowdown. But at the same time, also, there is a lot of fear about inflation driven by tariffs. So we are in that balancing act of how far can we normalize, taking into account the inflation fears. So I do believe that interest rate will normalize, will definitely not come back to what we've seen 4, 5, 6 years ago.
Okay, not back to zero.
No, not back to zero. I think that's an environment that is well behind us, as far as I think. But definitely a small normalization. But again, the Fed is reassessing those volatility driven by tariffs and geopolitics to understand exactly what is the right balancing act.
Speaking of an environment that's behind us right now, new structure, new settings, of course, for you and your business. So how have things changed for you and your team?
Look, you've heard it from our CEO yesterday. We believe that we have the right strategy at the moment. We believe we focus on the right parameters to drive what our clients want from us in this new world order. What we have changed is our operating model in order to be simpler, more agile, in order to be able to deliver that strategy. So as far as our business is concerned, we'll remain focused on driving where we have a right to win. We'll keep driving our transaction banking business, which is our security service business, our payment business, our foreign exchange business, where we are leaders. We'll also keep building our finance-led activity business, specifically in fixed income, but also in our prime brokerage.
Yeah, I mean, why don't we talk about prime brokerage? How are you going to lean further into that? Really fee-rich business.
Yeah, prime brokerage is part of this finance-led activity that we think is in our DNA. We are a finance-led bank. We've been building our prime brokerage capability over the past few years, and for the past few months, we've been seeing a real evidence of picking up market share with a large U.S. counterpart. So that's definitely something we're very pleased, but we still believe we have more to deliver.
Now, plans this part of the world, we were talking, you guys just brought on board someone we know on the show, George Sun, of course.
Yes.
Your priorities across debt capital markets here?
Yes, I mean, we have many priorities. One of them is to be a lead debt capital market providers in Asia Pacific across all the spectrum, across the emerging market rate, across the Asian rate, but also credit. We always look for talent in the market, internally as well as externally. So yes, we will keep driving excellency to deliver to our client the best possible service and products.
And you're happy with your footprint right now in the region?
We're happy with our footprint. It doesn't mean we cannot improve it.
Thank you so much. That was fantastic. Let's talk again soon and have a great day too here, of course.
Thank you,
guys, I'll send it back to you in the studio. That was Patrick George, Global Head of Markets and Security Services at HSBC. Avril.
David, giving us a bit of clues on HSBC's commitment to the region in your conversation there. Much more ahead, and of course you have a full day ahead of you from the HSBC Global Investment Summit, and we'll be speaking with their corporate and institutional banking CEO and the co-CEO of Asia and the Middle East. Former senior White House trade advisor Kellyanne Shaw talks Trump tariffs, plus 91 unpacks the outlook for global investment trends. But first, we dig into Australia's pre-election budget tax cuts with Finance Minister Katy Gallagher. Live to Canberra next, this is Bloomberg.
Every Australian taxpayer will get a tax cut next year and the year after to top up the tax cuts which began in July. Yeah. This will take the first tax rate down to its lowest level in more than half a century.
Australian Treasurer Jim Chalmers there in his budget address to Parliament. Let's get more on Australia's latest budget that included some unexpected tax cut and an extension when it comes to energy rebates aimed at soothing voters' cost of living concerns. Bloomberg's Paul Allen is standing by in Canberra with our next guest. Paul.
That's right. Thanks, Heidi. Yes, I'm joined here in the Senate courtyard of Parliament House by the Finance Minister, Katy Gallagher. So, as always, thank you so much for joining us on what is traditionally a very busy morning, so we really appreciate your time. And we just heard from Jim Chalmers there talking about the tax cuts, which we did not expect. But there has been some criticism this morning that they're quite small. It's the equivalent of about $5 per week, depending on how you slice and dice the numbers. So $17 billion over 3 years. Perhaps the money could have been better spent elsewhere.
Well, the budget's always a series of balancing decisions and balancing, requests for investment and other ways of dealing with all the pressures on it. But we see these as a good way to provide a bit of relief to households. They're a top-up to the tax cuts that were passed and started flowing in July last year. And really, when they're put together, together with those tax cuts and once fully implemented, it'd be about, for the average worker, about $50 a week. So we're not pretending that they aren't modest, that's for sure, but they're topping up the work that we'd already started a year ago. Well,
that's true. I mean, the Treasurer, Jim Chalmers, also used the word modest when he was describing them. And when you consider the size and the timing of them, was there some consideration given to the inflation risk as well?
Well, that goes to the timing decision to have them start next year, really to make sure that inflation is back into band and that, we are mindful. Obviously, we've done a lot. Australia as a country has done a lot of heavy lifting to get inflation back down to more normal range, and we don't want to jeopardise that. And so the timing of when they come in was factored into our thinking and into the Treasury forecasts.
And when it comes to forecasts around inflation, that's forecasted to be back inside the RBA's target range, making it pretty hard here to mount an argument against further easing, right?
Well, we obviously leave the bank to make their decisions. Our responsibilities are contained in the budget, but we are really pleased the Treasury forecasts have inflation turning sustainably or coming back sustainably into the band 6 months earlier than had been expected at MyEFO, and so that's really welcome news, obviously. We'll leave the bank to make decisions based on the information they have.
Turning to some questions around spending as well, we were expecting to see perhaps a substantial boost to defence spending, considering, well, the geopolitical environment at the moment, potential pressure from the US as well. Was there a temptation to go a little bit bigger there because we're rising to 2.3% of GDP by the early 2030s?
Look, we put a lot of work into working out the priorities in defence, and the Defence Minister has led that in conjunction with his department. We've found an extra $50 billion over the medium term for defence. That's not an insignificant amount of money when you think about it. We've brought forward some money in this budget based on a defence advice about their capability needs, so that is met. But I also think you should look at defence and national security, bringing in all of the intelligence agency, the work that DFAT's doing to stabilise our relationships in the region. It is very uncertain global times, as everybody is witnessing, and so investments in defence are essential, but so are investments in a whole range of other areas to make sure we keep Australians safe.
And of course, the huge domestic issue in Australia, besides cost of living, which I'll get to in a moment, is the perennial tightness in the housing market. Yep. Now, there is, of course, a ban now on foreign buyers buying existing properties for 2 years from April. It's some addition to the Help to Buy scheme. But do you feel like there was a missed opportunity here to really throw down ahead of the election?
Well, housing has been a key priority for us. We have about $33 billion going into a variety of programs for all parts of the housing market, whether it be, in foreign ownership or in homelessness funding, to supported housing, affordable housing, how we support renters. So I think the investment level we've got there is flowing. It's flowing through this budget as well. I would love a silver bullet that just, we snap our fingers and we solve all of the pressures in the housing market. That's not realistic, but there's no shortage of investment or commitment by this government to address those supply issues.
We also have a forecast for deficits for a decade. Is there any sense of urgency to do something about that sooner?
Well, when you look at the budget, you'll see under this government we've had the biggest nominal turnaround, the most significant nominal turnaround in the budget forecasts of any first-term government. So we've improved the budget bottom line by over $200 billion. Again, massive numbers, I know, but we've improved the deficits, we've delivered 2 surpluses, we've paid down debt, and we're paying, because we've lowered debt, we're paying lower interest bills on that debt. That all matters. So we have absolutely, since day one, it's probably the key part of my job is to work out how we make sensible savings and bring those deficits and head the budget back into balance in a reasonable time frame. But we also have to be realistic that we have to pay for services, for Medicare, for defence spending. There's no shortage of pressures on the budget, and the budget balances all of those up.
I guess to a large extent the job's not made tremendously easier by the uncertainty in the trade environment at the moment. How well positioned do you feel the books are to deal with hits from that sphere?
Yeah, well, obviously, that's covered in the budget books. The Treasury obviously provide us with advice on that. I think, there are some measures there to look at other strengthening our trade relationships in other areas, in looking at how we encourage people to buy Australian. But the global uncertainty certainly hangs over this budget, and I think we're in pretty good shape to deal with what comes next. And obviously, governments need to make decisions based on, the facts when they come, but I think we're pretty well positioned, and the budget has certainly taken those uncertain global times into consideration.
Well, we're anticipating election, obviously, very soon, and one of the things the media loves to look for in an election budget is so-called decisions taken, not yet announced. Only $1.5 billion set aside there, so have we had all the big announcements, or can we anticipate some more?
Well, it's a very responsible budget. This isn't about elections. This is about doing the right thing at the right time. And so, yeah, the decisions taken but not yet announced are very small relative to other election eve budgets. But we take, Jim and I, in our approach to budgeting, is we make the decisions for the right reasons, and then the politics takes care of itself.
And in terms of the politics taking care of itself, are you confident that this is an election-winning budget? We're going to be having this conversation again next year?
Well, we'll certainly hope so. That's what we'll be campaigning for. But I think the Australian people will see what we've tried to do with this budget, which is help them where we can with Medicare and tax cuts, but also get the budget in better shape to deal with all of that global uncertainty, as you've outlined. All
right. Finance Minister Katy Gallagher, thank you so much for joining us, recapping the events of the budget, some surprise tax cuts there, some cost of living relief as well, and of course we are anticipating an election to be called within days. Haidi.
The suspense. Bloomberg's Paul Allen there in Canberra covering the Australian budget the morning after for us. More ahead on the Asia trade. In the next hour, we'll be speaking to the Shadow Treasurer, Angus Taylor, for his take on this budget. This is Bloomberg.
Welcome back. Some top corporate stories we're tracking. Battery maker CATL has received Chinese regulatory approval to proceed with a potentially blockbuster share sale in Hong Kong. The company says it has the green light to issue about 220 million shares, potentially raising $5 billion. Hong Kong seeing a flurry of jumbo-sized share sales with the likes of Xiaomi and BYD, raising more than $11 billion just this month. Qualcomm has launched a global antitrust campaign against chip designer ARM. Although ARM is Qualcomm's biggest supplier, the longtime partners are competitors in the computing semiconductor market. Sources say Qualcomm's complaints to regulators on 3 continents argue that ARM is guilty of anti-competitive behavior by restricting access to its technology. Let's take a look at how U.S. futures are shaping up, and we're seeing that firmness, perhaps an extension of the gains overnight, despite tariff concerns. More ahead. This is Bloomberg.
take a look at what we're watching. We're about half an hour into the start of trading here in Sydney as we get that sort of post-budget reaction, I guess. Some unexpected sweeteners, tax cuts, as well as the extension of an energy rebate was sort of the main takeaways in that pre-election budget. And speaking of which, of course, we're waiting for that election date to be announced potentially over the next couple of days or so. So being very watchful on that. We're seeing gains of about 0.7% at this point in Sydney. Singapore Nikkei futures also looking pretty positive, a bit of a pop there. And also seeing an extension into a fourth day of gains when it comes to US stocks. The futures picture there also looking a little bit to the upside as well. We had a pretty strong session in the US, despite, of course, the consumer sentiment surveys coming in pretty dismal. We're clearly seeing on the household side the concerns about the resurgence of a trade war and the impact of Trump's tariffs. Geopolitics also in focus today, with the US saying that Russia and Ukraine have agreed to a ceasefire in the Black Sea. The Kremlin confirming the truce, but says it is conditional on lifting sanctions. For more, let's bring in Bloomberg's Michael Heath for more. So what do we know, and what are the, I guess, broader implications when it comes to these conversations that are ongoing?
Yeah, Heidi, I mean, it's obviously really good news if there is, if this ceasefire does go ahead. But I think what we're seeing is a bit of a pattern here that what the US readout from the call is always a little bit different from the Kremlin's version of it. And in this case, the Russian side is saying that the US has agreed to lift sanctions on banks and companies that are involved in agricultural exports. And the US is it's sort of it's a bit more nuanced than that. It's not quite such a direct improvement for the status of those firms. But I think it's really the proof is in the pudding here. Whether we do see any attacks continue. Whether Russia abides by that, whether Russia's prepared to take a next step in terms of expanding this truce, I guess is what we'll see. Now, on the Ukrainian side, they seem to be agreeing with everything that the US is requesting, and it seems that President Zelensky is sort of determined, particularly after that blowout in the White House a couple of weeks ago, that he'll keep himself completely aligned with the US unless it comes to some sort of red line, which we're not aware of at this stage, and leave it to Russia to be seen doing the foot dragging. The problem is, because of President Trump's real affinity with Russia, there's every chance that in the haste to get a deal that Russia's going to get a lot more than perhaps Ukraine would want, or that it would warrant in this situation, given that Russia has always been the aggressor in this war. So, yeah, I mean, it's good. It's good that anything that stops shooting and efforts to bring down the attacks on civilians are great, but proof will be in the pudding.
Yeah, I think, it looks promising, but as you say, proof will be in the pudding. What about when it comes to the importance of the Black Sea as a trading route, and how soon can we potentially see this easing of the disruptions on trade flows that have been affected since the conflict broke out?
Yeah, I mean, look, I think both sides are pretty, particularly on the Russian side, they're fairly keen on this. I mean, Ukraine has managed to keep doing a lot of its trade and getting out its grain exports and these sorts of things, and Russia has to a certain degree as well. The other thing is that Russia's Black Sea fleet took an absolute pounding from Ukrainian attacks, whether it's through drones or missiles and those sorts of areas. So it had really, the military situation there in terms of shipping had been, pretty limited on the Russian side. So I think it probably just gives everyone a bit more a sense of assurance. But again, Russia's really looking for a bigger picture here than just the conflict. It wants some sanctions relief, and what it's prepared to do to achieve that is going to be a really interesting question to watch. Whether it is prepared to just stop all strikes, or whether, if it doesn't get as much as it wants, it will resume. We'll just have to see. But at the moment, it's sort of step by step, and we'll have to see how that goes.
In the meantime, of course, the top story, I would say, on the Hill as well as around the world for any kind of geopolitical watchers has been this group chat, right? The war planning, the war gaming inside the Signal chat. We heard earlier something, I guess, like an explanation from NSA Mike Waltz. Let's take a listen.
We're going to get to the bottom of it. I just talked to Elon on the way here. We've got the best technical minds looking at how this happened. But I can tell you for 100%, I don't know this guy. I know him by his horrible reputation, and he really is the bottom scum of journalists. And I know him in the sense that he hates the president, but I don't text him. He wasn't on my phone, and we're going to figure out how this happened.
other than the fact that he clearly shares President Trump's view on the Atlantic. But he also said that he's spoken to Elon Musk about this. I mean, it is just an incredible story. It
is extraordinary. I mean, it's just such an amazing breach. And of course, despite what he said, it was obviously a very responsible journalist who's not, who's obviously sat on this and not revealed it to anybody or anything like that. But yes, it is extraordinary. And the fact that there's not going to be any sort of implications for anybody who's involved is just stunning. You can imagine if the Democrats were involved in this sort of leak or something like that. It's amazing. But it's almost defies belief. But it is the case, sort of, that as long as President Trump is covering for these officials and not prepared to have any consequences for them, then nothing will happen there. But yes, bringing in Elon Musk, you sort of think that there'd be government departments that would look at this and be dealing with that security. I mean, Musk's tentacles seem to be reached to extraordinary areas within the US administration now. So yeah, just an extraordinary story.
Indeed, and I think consequences or not, it's just a reminder of all of us to kind of be careful with these chat groups. Bloomberg's Michael He for us there. Thanks so much. Senior foreign officials and major tech companies, meantime, are pushing the Trump administration to rethink the country's global semiconductor strategy as the U.S. prepares a controversial framework for controlling AI development around the world. Let's bring in our China correspondent, Min Lo. So, Min, where have the strongest responses been seen so far?
Well, obviously, the big tech companies like Oracle, Nvidia, not surprising given that they will see their top line impacted by this framework. And Nvidia had been one of the early ones that had opposed to this when Biden administration officials unveiled this in their last week in office. And just to give you a context, we're talking about this AI diffusion rule. It divides the world into 3 categories. The top tier of countries include close to 20 close U.S. allies in Europe and East Asia, and they will have the most unfettered access to U.S. advanced chips. And then at the opposite end, you have countries like Russia and China that have the least access, and the rest of the world fall into the middle tier, where they would get a computing cap in terms of how much computing power can be exported to them, and data centers in these countries have to comply with U.S. standards. For example, they will have to implement cybersecurity protocols. They will have to strip away any Chinese hardware from the supply chain. So companies like Nvidia, Oracle, they are calling for the repeal of this entire framework and to start the regulatory process from scratch again. Nvidia is saying that it would lead other countries to adopt alternative technology that would be at a disadvantage to U.S. national security. And Oracle is worried about this particular provision that would limit U.S. companies' share of their computing power in any single country to 7%. And because Oracle had been planning to invest this $6.5 billion in data centers in Malaysia, that would likely, just go above that limit as well.
What's the broader sort of impact on the trajectory of AI development in China, which of course, has either sort of gained momentum, or certainly the global attention on it has gained momentum in the last few weeks?
Yes, we have seen so many headlines of these tech companies launching their own large language models. I think the latest breakthrough is from Ant saying that they are able to lower the cost of training by 20% using Chinese chips. And of course, this framework from the US has changed the rules of the game for China. They are now doubling down on making their computational process more efficient so that they don't have to rely on the most advanced chip. And it definitely puts US companies at a distinct advantage because they have access to the latest, the best, the chips with the best performing power per unit of power. But it's also the rest of the world, right? All these are the countries that count Chinese companies as a big client, because many of these Chinese companies are also looking to rent AI servers overseas. So they will be watching this framework very closely, whether Trump administration officials will keep it in place as is or make some changes to that framework.
Chips and AI really the battleground in geopolitical rivalry. Min Lo, our China correspondent for us there. Now a look at other top global headlines now. A federal judge has temporarily blocked the Trump administration from detaining another Columbia University student. 21-year-old Yun Seo-chung says she was targeted by immigration officials for potential deportation after taking part in anti-Israel protests. Chung is a permanent U.S. resident who came with her family from South Korea at age 7. Japan has launched a joint headquarters for its self-defense forces, putting its military branches under a single operational command. The new command center reflects the country's efforts to make a more capable fighting force amid growing challenges from China and North Korea. Japan has also created a new division of its military modeled on the U.S. Marine Corps. And coming up, we'll take you to the Boao Forum in China.
Avril, of course, we refer to this often as China's Davos. We'll be speaking with the Centre for China and Globalization next. This is Bloomberg. Qantas CEO Vanessa Hudson says the airline is willing to re-establish routes to China if demand proves to be strong enough. She told Bloomberg exclusively that air travel appetite remains healthy and that she's optimistic about the business outlook despite global trade tensions.
We're seeing demand remain strong. Strong domestically for both low cost and premium, but also strong outbound as well. So we're feeling really optimistic about the next 6 months and beyond. And the appetite that Australians have for travel has remained strong, and we've seen that now for a number of years.
Where is strong? Give me an idea of where you're seeing the strength at the moment. Because if America's rolling over a little bit, where is the strength elsewhere?
Really, we're seeing it in all our customer segments. So corporate travel is still recovering and it's growing. We're seeing it in premium leisure. We're seeing it in low cost, particularly. There's a cost of living pressures in Australia like there are in many countries around the world. And despite that, we're still seeing Australians want to take a holiday, whether that be domestically, because Jetstar flies pretty much to all of the leisure destinations domestically, but also internationally to all of the premium destinations that we have, but also into Southeast Asia. Bali is a massive holiday spot. Korea, Vietnam, Japan particularly. We're seeing so many Australians holidaying in Japan.
You don't go to China. Could that change?
Well, we fly to Hong Kong, and last year we suspended services into China because we just couldn't see the demand. But yes, absolutely, if we see the demand, we'll basically put our services back.
But a lot of capacity in that market at the moment.
There's a lot of capacity from China into Australia, and the demand just is not commensurate with that. So we see that, we redeployed those aircraft that were flying to China into Singapore and into India, and those services are doing really well.
In terms of what you see going forward, do you see any impact from tariffs? Every morning we seem to wake up and want to have a tariff conversation. Is that reaching down into Australia right now? Any impact in terms of consumer behaviour or what corporates are talking about? We appear to be heading towards a more fragmented world.
Well, right now, we're not seeing any impact. And if we did, we'd obviously let the market know. But we also have a very flexible fleet. And if demand patterns change, we will also move our fleet about. So that we do domestically, like that example with China, we would do that domestically as well. So we feel that we're really well set up with the right flexibility to be able to respond in any demand environment.
And that was Qantas CEO Vanessa Hudson. More ahead on the Asia trade. This is Bloomberg. The Boao Forum for Asia begins today on the southern Chinese island of Hainan, and forecasts released by the forum show an upbeat outlook for Asia despite global economic uncertainty. Let's cross to Boao and our chief North Asia correspondent Stephen Engel, who's there in beautiful sunny Hainan with our next guest.
Yeah, that's right. My 19th year covering the Boao Forum for Asia here on Hainan Island. And of course, there are internal challenges to the domestic economy and external shocks that, of course, Li Qiang at the China Development Forum talked about, possibly exceeding their expectations going forward as we approach next week the possibility of further tariffs from the Trump administration. For more context on this, let's bring in our first guest of Boao 2025. It's Henry Wang Huiyao. You are the president and founder of the Center for China and Globalization. You're also a former counselor of China's State Council, essentially China's cabinet. So, we saw Steve Daines, the senator from Montana, come to China earlier this week at the China Development Forum. He was essentially the unofficial envoy of Donald Trump. He delivered the message, as he told us in an interview on Bloomberg, that there cannot be further negotiations, further mitigations on further tariffs until China solves the fentanyl issue, which is paramount to these 20% tariffs that Trump added. What can China do?
Yes, thanks, Steve. That's a great question. I think that what China actually also during the Biden administration, you remember we had many exchanges, dialogue, Homeland Security and Chinese Ministry of Public Security have met many times. I even remember recently the former Assistant Secretary of State wrote an op-ed or article in the New York Times or Wall Street, I don't remember, that he actually said 2024 fentanyl deaths dropped to 27%, because China has taken a lot of actions already. So I think there still can be more can be done. So I hope that kind of dialogue we should continue. For example, between Homeland Security and Ministry of Public Security and at those working level. I mean,
is there a face-saving move that China can make? Can they make a list of moves that they've done to appease the Trump administration? Because right now it's a standoff.
Yeah.
Because Trump is not going to basically, accede to any kind of further dialogue until fentanyl is properly addressed.
Yeah, I think the marching order has been given. I think during even during the Biden era, that has already a lot of consensus has been made. Now it's we should really continue that momentum because as certainly was not on the rising side, it was on the decreasing side. That means the effort has been taking place. But also, furthermore, I think China actually is good at doing things, not good at talking about what have been doing. So I would think that could be also lift up a bit. China can really say more. What have they done? And really encouraging U.S. officials and U.S. relevant parties to come and see what has been done. And actually further discussion to have new measures and new tough sanctions and whatever to really stop this kind of complaints from U.S.
How important is it then to have a Xi-Trump summit to help kind of give the marching orders to the various bureaucracies? As Steve Orlins told me at the CDF, he said they need that high-level meeting so the various bureaucracies get their marching orders and come up with constructive policies to resolve their differences.
Absolutely. I really think that this high-level meeting is really important. I think that probably the experience for the last 8 years, the head of state diplomacy is probably the most effective diplomacy that China U.S. is going to have. So I think President Trump is right. He trying to invite President Xi to his inaugural, and Vice President Han Zheng went there, and then he's saying he's expecting to meet President Xi again. So I think that China is really probably looking forward to that as well. But just how to have the venue. I don't think Chinese leader would like to have a treatment of the Zelensky at White House. So let's really work out the details. I'm sure the working levels and the government officials are doing that.
So what terms would be acceptable to Beijing to either go to Washington or invite Trump to Beijing?
Well, I think there's quite a few occasions to do that. And first, I noticed the Wall Street has mentioned that June there could be something.
Birthday summit.
That could be, because I think it's by that time, the Ukraine-Russian war will come to some kind of crucial negotiating moment, and having China's help and also involved on this peacemaking would certainly make the final difference. And that's what the President Trump said. If China and U.S. works together, nothing in the world we cannot resolve. So I think June would be probably a good time. But also another time is the UN. We're going to have 80 years peace. Of the funding of the World War II funding the UN. So. I'm sure that would be a big General Assembly meeting of leaders. That could be another occasion. And another occasion could be, September 3rd is that China's going to have a victory celebration for anti-Japanese invasion, 80 years as well. Yeah. I'm sure they're going to invite some world leaders. And President Trump could be happy to come as well.
What's your assessment of China's ability to absorb or essentially take the full force of further tariffs? They seemed pretty upbeat here at Boao. They were pretty upbeat at CDF.
Yeah. The problem for tariff is a little different story now. You see, that has been launched in the first term of President Trump, and then that has been almost 7-8 years now. And I can give you a number. The bilateral trade has not decreased since the trade war, has almost come up 20%. Yet China's dependency on U.S. trade used to be 20% of the total trade volume. Now it's only almost 10% now. So around 10% now. So you can see that trade tariff is not really effective on China. China has already adapted to that. China has been going global. China has been really, finding all kind of way to stimulate domestic consumptions. And China's trade more with BRICS countries, global South countries now. China's trade with Belt and Road countries already exceeding half of China's trade. So China is already diversified. So I think what we hit most are those countries really depend on the trade, like European countries. Some are 90%, depending on trade, and also many more. So I think that probably is not a good approach. But I understand that is really get attention and get people to the negotiate table, which is fine. China negotiated the phase 1 deal with U.S. China can do probably phase 2, phase 3. I think that really can be done. I think the key is that we need to start a dialogue, visit minister, secretary, let's do it.
The domestic economy has some momentum following the National People's Congress, and there's some fiscal stimulus that's going to help boost domestic consumption. But can it really boost that domestic consumption when the property sector is still hitting new lows?
Well, I think that certainly helps now. I think there's a big confidence boost in the private sector. President Xi met all the private leaders, Jack Ma and all the rest, and that is a big boost. I heard a lot of people, starting to really invest and working hard now. And then President Xi is going to meet all the multinational CEOs on Friday coming up. Right. So that is really giving all those business community a further assurance. That's number one. Number two is now that the consumption of domestic economy. China State Council just recently launched a lot of new measures to stimulate. Used to be the local government performance. It's not measured by how much you stimulate local consumption. It's just by how much you build on roads, bridges. Now they changed that. So we're going to see how much you stimulate domestic consumptions.
Right.
And third,
that's key. What's third? What's third? Quickly.
Third is of course, there's AI. Now it's sure. AI plus with the DeepSeek. As now every company, every hospital, every school, you say, let's get the AI model cheap and affordable, and let's do it. So there's AI revolution going on in China right now. And then finally, the green revolution, China is already taking lead. Sure. So all those new elements could offset some of the real estate slowing down.
Henry, thanks so much for your time.
Thank
Always
you.
Good to see you at BOA, and I saw you at the China Development Forum. All right, plenty more coming ahead here from sunny BOA, Hainan Island. Back to you guys.
Our Chief North Asia correspondent Stephen Angle there at the Boao Forum. Coming up in the next hour, we'll be back also in Hong Kong at the HSBC Global Investment Summit to speak with the bank's corporate and institutional banking CEO. Australia's opposition gives us their response to the Albanese government's budget. Plus, we'll be discussing Hong Kong's push to become a wealth management hub with the Financial Services Secretary Christopher Hui. We do have the market opens in Seoul and Tokyo almost upon us. This is Bloomberg.
This is the Asia train. We're counting down to Asia's major market opens. And as we count down, Heidi, it's really the continued clock inching closer to April 2nd. Ultimately, what are we going to see? Maybe a two-step process as far as tariffs are concerned. But until that day, there's no clarity. I think that's going to be a key overhang still for markets, despite what U.S. futures are pointing towards.
Yeah, what is starting to become ever clearer, though, Avril, is that we are starting to see the economic impact at the moment from the confidence levels when it comes to this consumer confidence gauge that we saw in the US overnight falling to the lowest in 4 years. So clearly we're seeing households and consumers are feeling that uncertainty when it comes to trade tariffs and how that potentially impacts their spending power at a time when that final mile of disinflation is proving to be quite sticky as well. At the same time, Avril, we're looking at geopolitical developments with this potential ceasefire in the Black Sea, adding a little bit more optimism when it comes to a potential agreement between Ukraine and Russia.
Yeah, but as we spoke to Mike Heath earlier also, there seems to be some of these caveats that Russia wants to see. So even if we do see that truce, how long might that last and when can it actually be implemented? Traders digesting all that. We also got some data in the past hour, actually about 10 minutes ago, out of Japan, the services PPI, and it's a firm number, although it was a bit softer than expected. And I think this helps traders get a bit more excited as well for Tokyo CPI later in the week. Overall, inflation in Japan has been pointing in the right direction for a BOJ rate hike. Does this get us excited enough for the month of May in terms of that continued rate hike trajectory from the BOJ? We're seeing dollar yen, interestingly, still below the 150 handle, actually moving sideways at the moment. Japan was sort of the outperformer in equities across the region yesterday, despite the tariff overhang that continues for much of today, it looks like. And flip the board, take a look at Korea as well, as we saw a bit of that trepidation a day ago. Gains, but really not that convincing, Heidi.
Trepidation is a really great word for is describing the sort of moment in time, right? Even as we start to see some optimism in the day, it is that sort of post-budget reaction that we're seeing in Australia as well. Perhaps some relief, given that we have had some relief for households, for taxpayers in particular with these tax cuts, as well as the extension of the energy rebate. That surprise extension of the tax cuts was really the biggest takeaway. Also incentives for families with children, early childhood education, student debt holders, and some consumer names there as well. We're seeing upside of about 0.6%. The Aussie dollar hovering at around that 63.05 level. We saw that decline in the greenback on the back of the, somewhat troubling consumer sentiment numbers that we had in the US session overnight. Watching treasuries at the moment, but we're also watching Aussie bonds and the outlook for Australian bonds looking like we're going to see that sort of continued downward trajectory through to next week's RBA decision, given that we have had the surprise tax cut in the budget, a bigger than expected fiscal deficit at play here as well. So we could see some negativity from that bond trader point of view, suggesting that that rate cut priced in for July potentially under threat from the fiscal situation, depending on how that plays out. Let's get back now to the HSBC Global Investment Summit in Hong Kong. David is there with our next guest. Dave.
Hi Heidi, hi guys. Yeah, we were just chatting here on really what the state of, I guess, the worldview is right now as HSBC's clientele really gather here for the second day of the conference. And really to get a sense of, a lot of the stories that you guys talked about there, right? The level of uncertainty, should we look through? And to what extent should we look through the noise currently? And, what does the world look like in 12 months? And, do we have a good gauge of that at this point in time comparable to previous periods of uncertainty? Let's put that question right now. And joining me here in set is Michael Roberts, CEO of HSBC Bank PLC, and of course CEO of the Corporate and Institutional Banking Unit. Good morning and very nice to see you.
Great, David. Thank you very much for having me.
Lots to talk about, the changes to the role. We'll get to all of that in a moment. But what's your sense of, you're here, you're facing your clients. What's the mood in the room?
Yeah, no, and look, I think you mentioned it. There is a lot of uncertainty. There's a lot of unpredictability. Obviously, the Trump administration's policies have, I think, created a lot of tumult in the world today. And so I think you start with that, but there is this view that you need to look through it. And I think you just mentioned that, is that this is a lot of short-term unpredictability and a lot of volatility. But I think clients are saying, okay, fine, we've worked through it before. We just need to understand what the rules of the game are, and we need to define those rules. And once we do that, I think they'll continue to focus on growing their businesses, and perhaps that means some change in their supply chains. Investment plans may be put on hold for a while, but I don't think there's this view that the world is headed into a global recession or that there's going to be a lot of real catastrophic economic events occurring. But there is uncertainty, and as you know, and we all know, the market doesn't like uncertainty. Yeah. Companies don't like uncertainty. And so that is really what needs to be, I think, finalized and really focused on by the administration. They need to bring certainty to the dialogue.
Yeah, Patrick George joined us about an hour back, and he described it as there's no crisis, there's no external shock like a pandemic or a GFC, but there is a level of uncertainty out there. And I think what that has done, one, is
it's put some deal making on hold for now.
Very much, yeah.
What's your outlook there? Do things improve?
I would say prior to the administration taking office, there was this whole view of the unleashing of the animal spirits in the United States. It was going to be a boom year for deals. I think certainly all the money was lining up to pour into transactions. That's actually not occurred. And so I think that's one very cautionary note, that unpredictability really causes companies and investors to think twice about investing their money. And so I think that remains until there is greater certainty. Right. And that I don't know how long that takes. I'm hoping within the next 3 to 6 months. There is still a lot of money, and it is a lot of money looking for yield, looking for transactions. And a lot of companies as well. I mean, they see the world as certainly providing lots of opportunity, but they're not going to invest unless there is greater certainty. So.
Do you notice a difference between clients in the Asia Pacific and their attitudes towards this, towards those elsewhere?
Yeah, I do. I think if you can maybe have a barometer of who is the most pessimistic, I would have said a spectrum, like a continuum of pessimism. I would have said, before the administration took power, clearly Europe was very pessimistic. The U.S. was very optimistic. Asia was somewhere in between. Now it's kind of flipped. We've got more pessimism in the United States, rising optimism in Europe, although clearly lots of uncertainty. But I think in Europe is view that they've got to do something differently. This is now the catalyst. You see that the response to the German announcements in the various markets today, the equity markets in Europe is finally, after many, many years of being in the doldrums, is starting to revive a bit, which is good. I think Asia, of all of them, of all the regions, is much more calm and much more focused on the longer term. Yeah. I think most Asian manufacturers here and investors think they can get through this. Asia itself is growing. China, as it hopefully hits a more stable point and starts coming out of the real estate-induced issues, will be in a better shape. I think Hong Kong feels good in its role of superconnector. And I was just in Southeast Asia 2 or 3 weeks ago. I didn't notice any sort of downward draft at all. Right. And then you have India right next down there. Yeah, exactly right. So it's in a very different world. So when we think about global calamitous sort of events, as Patrick mentioned, there are really none. This is a policy event. Right. And policy events, they come and go. As we all remember back to Trump 1.0, there was also a lot of turmoil and unpredictability. The world got through it. The world figured out what that meant. Yes, this is more comprehensive. Yes, this is faster. Yes, this does have probably bigger geopolitical impacts. But I think, most companies, most investors will figure out in time how to work through this.
Yeah, and I'm curious what Mario Draghi is going to say when he talks in about, I think it's about 40 minutes from now. And we were talking right before the interview started, and the changes to the bank itself. Right. And I was wondering why, in HSBC's case, it's garnering clearly a disproportionate, is that a good way to put it, amount of attention. I mean, we've covered a lot of bank restructurings in the past. And for some reason, HSBC, when this one comes up, like everyone seems to be talking about it. Let me put the question this way. What's changed with your role? Yeah, okay. And you're right. It has garnered a lot of attention. I don't know why, because there's a lot of bank restructurings going on. In fact, right now, other banks are doing the same thing. Yeah. I could name them. And we're all kind of doing the same thing. And what we're really trying to do, and I'll get to my role, is to simplify the bank, to streamline decision-making, to be really focused on what our core competencies are. So we've set up our 2 home markets in Hong Kong and the UK, where we have clear demonstrable strength, in particular in Hong Kong. And yet we also are a global bank. We're a connector bank, both in the wholesale businesses, which I run, the corporate and institutional bank, as well as our wealth and retail businesses, which Barry O'Byrne runs. And we wanted to segregate them so we actually knew what all 4 businesses were doing and had a very clear, transparent line of sight on how we were performing. We can make better allocation decisions on both people, resources, investments, but also ensure that we were connecting all parts of the organization in a much more sort of, I think, cogent and coherent way. So that was the real basis of all of George's strategic changes. Yeah. So what we're doing in the CIB, or the Corporate Institutional Bank, is really just doing that. We're simplifying the organization. We're bringing together our 2 large banking organizations together, which had been very much separate before.
And when you have separate organizations, they build up a lot of separate policies, procedures, people, platforms, technologies, etc. So we're putting all that together. So that really does allow us to focus on the banking business as one business, not two. So same go-to-market strategy now, eventually same policies and procedures, same mission, same goal, same approach. Very, very helpful. I think it's better for our clients. In fact, our clients have responded very favorably to this. And it allows us to make, I think, better investment decisions as well.
Right.
And so we're moving very fast, and maybe that's why people are so focused on it. It is not the usual speed of HSBC. And I would say that under George's leadership, we're going to be faster in everything we do. I mean, this is why we're doing this, to show the world we can be fast. HSBC in the past was, I think, often criticized as being too slow, too complex. So we want to be simple and more agile. And so moving at this speed and this pace is really kind of the reflection of what we want to achieve.
And speaking of the rate of change, let's put it that way. Are you looking? So when can we expect announcements around? And will there be changes to headcount inevitably?
Yeah, so we are changing headcount level today, and to be honest, we don't usually provide that as the number because I'm not focused on the headcount. It's really kind of the resulting organizational structure. We've done a lot of that change already, so most of the announcements at my level and 2 levels down have already been made, which is pretty, I think, fast and quick, given that we started in December. There'll be some other announcements. We will make an announcement on what we call our investment bank 3.0 strategy. What's it going to look like after we made the decision to wind down the investment bank in the West, which was the US, Europe, and London. And so that is in works, and we should have that within the next weeks. I don't know exactly when it'll come out, but it certainly will be longer than weeks.
Right. So it's weeks, not months.
It's weeks, not months.
Okay.
And really what we're trying to do there is to take our investment banking activities and our capital markets activities and design them for the future, not the past. Most banks, including this bank, had really a capital market structure, for instance, which really was built 30, 40 years ago. Hadn't changed very much.
Yeah.
What's happened in the meantime? The rise of private credit. The need to be much more agile in how we approach solutions for our clients. And it may be a solution that involves various types of financing. And for me, what I want our approach to be is that we're going to provide the best combination of solutions that meets the client needs, regardless of what part of the bank it comes from.
Okay.
And break down the various silos that existed before, break down those barriers, and we've got to be very cognizant. There's $3.7 trillion of private credit out there, which we need to use as partners when needed, use as investors when needed. Sometimes they're going to be competitors. And so we have to be much more agile in how we approach that and really think about how we're going to exist for the next 10, 15, 20 years, not the last 30.
Speaking of Apollo's, Jim Zelter will be joining us later on. Speaking of a peer and maybe competitor, it's getting loud. Final question for you. So we had a story out yesterday that you were part of the changes, might be small, that you're looking at maybe outsourcing some of the trading operations to. So can you comment on that?
Yeah, that was, I don't know where that report came from. That is not the case at all. So I'll clearly go on record. Not the case. Highly focused all of our fixed income trading operations. That's a centerpiece of what we're going to be doing going forward. Our fixed income capabilities are really one of the strengths of the firms. We would never trade out those capabilities. So I don't know where that report came from, but completely false.
Well, thank you so much for the time, and we'll let you go. I know it's going to be a busy day for you. Thank you for spending the time with us here. Michael Roberts there, of course, HSBC Bank PLC CEO and also CEO of the corporate and institutional banking arm, a new combined arm at HSBC. Haidi.
David Angus there in Hong Kong. We do have some lines from Governor Ueda speaking in Parliament and responding to questions, talking about the modest recovery in the economy. They'll keep raising rates if the economic outlook is met, that FX is more likely to affect prices than perhaps previously before, but that the uncertainties remain high for Japan's economy and the price environment there as well. We will leave it there, but current expectations are that the BOJ may see 2%, that goal being met by summer, and then potentially a pause. So further tightening ahead. 25 basis point hikes are predicted at the moment by economists to take that target rate to 1%. We're watching the impact when it comes to yen, just hovering under that 150 level at the moment. More ahead on the Asia trade. This is Bloomberg.
taxpayer will get a tax cut next year and the year after to top up the tax cuts which began in July. Yeah. This will take the first tax rate down to its lowest level in more than half a century.
We see these as a good way to provide a bit of relief to households. They're a top-up to the tax cuts that were passed and started flowing in July last year. And really, when they're put together, together with those tax cuts and once fully implemented, it'd be about, for the average worker, about $50 a week. So we're not pretending that they aren't modest, that's for sure, but they're topping up the work that we'd already started a year ago.
Australian Finance Minister Katy Gallagher there speaking with us a little bit earlier after Treasurer Jim Chalmers delivered his annual budget, which included some surprise tax cuts ahead of an election that's due in the next couple of months. Let's head back to Canberra now for more on the Albanese's government pitch to voters. Paul Allen is standing by with our next guest. Paul.
All right. Yes, thanks, Haidi. I'm here in the centre courtyard of Parliament House in Canberra with the Shadow Treasurer, Angus Taylor, and with an election due very soon, there is a possibility he may well soon be Treasurer. Angus Taylor, thank you so much for joining us today. I want to start with the tax cuts. We just heard there from the Treasurer Jim Chalmers, also the Finance Minister Katy Gallagher, describing these as modest. Now, you've been saying you're not going to support these. How do you frame that heading into an election?
Well, what we needed from this budget was a plan for the next 5 years and beyond. And what, in fact, we got was a plan for the next 5 weeks, which is the election campaign. And I think Australians are smart enough to know the difference. What we're seeing here is a choice between dependency, government dependency, and effectively a handout. It's not genuine tax reform of any description at all. It's an election bribe. And I think the alternative is our focus on economic management and restoring our standard of living. Now, the economic context for this budget and the election is incredibly important. We've seen in Australia a collapse in Australians' standard of living. That's their real net disposable income per person, but it's their standard of living in short form of almost 8% in 2.5 years. That's completely unprecedented. We've never seen that before. It's worse than any of our peer countries in the world. And I see it on the ground all around Australia. The pain of this is enormous. Giving people 70 cents a day starting in about 15 months' time, it's just not going to cut the mustard with the Australian people. What they know they need, and we know is necessary, is strong economic management, getting back to basics. That means delivering affordable, reliable energy, fixing our housing supply, which is broken in this country, balancing the immigration rate with that housing supply, cutting waste, slashing red tape, encouraging investment, backing small business. That's the way you get the rising prosperity we all want to see and the rising standard of living we all want to see. But that's not what we're getting.
Well, we are anticipating an election that is going to be called possibly within days. It's almost certainly going to happen in May. So what is the message that you're going to be selling to the electorate? I mean, you mentioned you won't support the tax cuts. You did mention a need for greater reform. Can you give us a little bit of detail around that? What can we expect?
Well, the first thing I'd say is that people can't afford another 3 years of what they've just had, another 3 years of Labor. People are poorer than they were 3 years ago.
So
I'll come to that. But the starting point matters. Context really counts in politics, as it does in business, I've learned over the years. And that context is incredibly important for the Australian people, because if people do not understand what they've had to go through, they can't possibly understand what needs to happen from here. But from here, to get back on track, we've got to beat inflation and boost growth. That means backing small business, tax breaks for investment, making sure accelerated depreciation gets that investment in our capital stock. We need investment because the investment in hard physical capital in this country has been in free fall. Making sure we fix our housing supply. That means breaking the infrastructure bottlenecks that have been holding back housing supply in this country. For the last couple of years, the government set a target of 1.2 million houses. They're not even going to get close to that target. Making sure our immigration rates are in line with our housing supply. And the truth is that immigration keeps going up. The forecasts keep going up, indeed. We will see a number approaching 2 million new Australians in just 5 years. We're a proud immigrant nation, but we can't cope with that kind of growth. It's been completely beyond what we can deal with, and we need to deliver affordable, reliable energy, and that means natural gas needs to play a much bigger role in the short term, as we need zero emissions nuclear generators, which most of the world is well and truly embracing or already have right now. We need those in the longer term in this country.
We've only got a couple of minutes left, so I want to cover something about the macro environment too. How well insulated do you feel Australia is in the current trade uncertainty, and what would you do about it?
Well, our problems are homegrown, but the context is still international, and we don't have the shock absorbers we had even a couple of years ago. Most households, their savings buffers are well and truly down. They're hand-to-mouth, particularly those with a mortgage, and that means not only are we lacking buffers in the government, this was a big deficit budget, red ink as far as the eye can see, $170 billion in deficits in just 5 years, huge growth in both spending and taxation. We've got household budgets that have got no resilience either. So we don't have shock absorbers here for global shocks. That's a very dangerous position to be in, and it's why the international environment, which, as you rightly point out, is very uncertain right now, is a very dangerous position for Australia to be in.
And in the geopolitical environment, do you sense that there's a greater need to spend more on defence? Is that something you would look at?
Well, we already have made important announcements. Adding a fourth squadron of F-35s is an important step in that direction. We realise that it's a more uncertain world. The Prime Minister himself says it's a more uncertain world than since the Second World War. Indeed, they're cutting back on defence spending. We do need to make sure our defence forces are strong, our capability is strong, it's resilient, it's agile. We're learning how important agility in defence is at the moment from what we're seeing in Russia and the Ukraine, and that is incredibly important. It's a big focus for us. We've got a budget and reply tomorrow night, and strong economic management and strong national security will absolutely be at the heart of it.
All right, Angus Taylor, Shadow Treasurer, thank you so much for joining us today. And as Mr Taylor mentioned, a budget and reply speech coming up. Probably get more focus than it normally would, with an election anticipated to be called within the coming days. Heidi.
Yeah, I'm going to pick it up for you, Paul. All eyes really on that. Paul Allen in Canberra for us. And if you want to catch more of that interview, including live past interviews as well, you can turn to our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions we talk about, plus become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg.
You're watching the Asia Trade. Some top corporate stories that we're tracking this hour, and Qualcomm has launched a global antitrust campaign against chip designer ARM. Although ARM is Qualcomm's biggest supplier, the longtime partners are also competitors in the computing semiconductor market. Sources say Qualcomm's complaints to regulators on 3 continents argue that ARM is guilty of anti-competitive behaviour by restricting access to its technology. Merck will pay as much as $2 billion for the rights to Jiangsu Hengrui Pharmaceuticals' experimental heart drug. Hengrui will retain ownership of the drug for the Chinese market. This will be Merck's second recent foray into China after its deal with Hansoh, to license a potential obesity treatment. Taking a look at some of the stocks that we're watching at the
Nintendo as well, as it's been surging, I think, by the most since the month of January. And really, it's this anticipation of the switch to gaming console. Goldman has also upgraded it to buy. So among the stocks we're keeping an eye on today.
We do have some breaking news when it comes to Australian inflation data just crossing the Bloomberg. This is for the month of February. What we're seeing is year on year, that CPI number coming in at 2.4%, a little bit softer than expectations, so 2.5%, and a bit of a pullback from January's 2.5% as well. That CPI trimmed mean year on year reading for February coming in at 2.7%, also a little bit of a pullback from 2.8%. So we are starting to see that picture easing, but the question is really that's going to be sort of enough of a level of strong disinflation that we see in those February numbers to really suggest that we're going to see further impetus from the RBA for a rate cut. So that expectation of 2.4% was in line with expectations from Bloomberg Economics. A lot of that was on account of softer prices when it comes to food and fuel. We have seen the core inflation readings trending a bit higher across recent months, but still within that 2 to 3% inflation target for the RBA. This will be a pretty key input going into April's rate decision in about a week or so. Inflation that's kind of slightly cooling, not really being seen as potentially enough to prompt it to ease at that meeting, though. So we'll continue to watch for how markets kind of look at this data. At the moment, though, across Asian markets, we are seeing a pretty calm picture there, seeking kind of a bit more direction, I guess. We had weak US consumer data, clearly showing the impact on confidence and household mindsets when it comes to the tariff risk. We're seeing broad upside, though. The Nikkei 225 up about 0.7%. We're seeing a bit of a post-election, budget bump, I should say, pre-election, post-budget bump here in Sydney, with the ASX seeing some gains there, as well as the Kospi up by about 0.4%. Some sort of buoyancy for Asian currencies as well, with the dollar holding that fourth day of advances. Let's bring in our Bloomberg MLife strategist, Mark Cranfield. The CPI, trending in the right direction, but the point is, I guess, is it strong enough for the RBA to be decisive, particularly now that we've got kind of the fiscal pulse of what we could see on inflation, the impact on inflation, I should say, from these budget measures?
Yeah, the fiscal policy will outweigh anything we see in today's consumer numbers. It would have had to have been a very big miss on that CPI report to have any influence on next week's RBA meeting. People fully expect the central bank to hold rates steady next week. And that was even how the expectations were going before we heard yesterday that the Australian government is doing a surprise tax cut, and they're increasing the fiscal deficit by a bigger margin than was expected for the year ahead. So clearly, people are very focused on when the next Australian election is going to be held, what the Australian government is doing in terms of trying to prepare investors and the electoral base for that forthcoming vote. And that's a much bigger impact for the RBA and what traders need to assess in terms of the market. FX traders and rates traders are looking for the next RBA cut to come around the middle of the year, maybe around July. But that will be under threat if the elections in Australia do mean that there's going to be a bigger spending plan ahead for the next fiscal year. That clearly is something that the RBA needs to work into its conference. It may have an impact on inflation expectations as well in the months ahead. So for now, the RBA is very much going to be on hold. It's not going to have a huge impact on the Australian dollar. Aussie bonds, meanwhile, will probably stay under pressure because they're being influenced by what's going on in treasuries and also the outlook for that bigger spending from the government as well. So this particular number, not a big deal, but the budget was. The surprise tax cut is pretty influential, and the RBA will be looking at that very closely.
Mark, talking about the fiscal side of things, China's also in focus, and authorities do seem to be kind of saying all the right things. But if you look at how Chinese tech has been faring in the past day, that Hang Seng Tech almost approaching correction. Why has the narrative sort of shifted? What do investors want to see for a turnaround?
That's mostly to do with cash calls. When you have two huge cash calls, Xiaomi and BYD, they sucked a lot of money out of the market, and they ask investors to pay up right at the top of the market as well, which is usually the case. Usually when companies want to raise money, they wait until their stock price has risen substantially. They need their earnings out the way, which is also the case with these as well. They both produced decent results. The stocks are trading at very high levels, so the companies want to cash in and they want to get some fresh funds for spending on the AI developments and other things in the months ahead, which is normal. And you would expect the market to come down once that happens. Of course, they also want to get ahead of CATL that's expected to announce results in mid-April. There could be an IPO soon afterwards. And if they do, it's going to be huge. It's going to be one of the biggest IPOs Hong Kong's ever seen. That will suck even more money out of the market as well. If you look at the way the Hang Seng Tech gauge has moved, it's come down around 10-11%. It's still way above the levels that we saw at the end of last year. It looks as though it's in the buy the dip kind of territory. This week will be a very good test for people that have a positive long-term view on Chinese markets. If investors really are confident, they'll probably start coming in around these kind of levels now, because this is where typically in major markets, when you see a 10%, 11% kind of correction, that's where you expect long-term money to come back in. We may well see it this week.
Yeah, it's been, I think, quite a comeback in terms of fundraising. I mean, you talk about CATL. We've also seen that from BYD and Xiaomi as well. Mark Cranfield, our Bloomberg and Life strategist for us. Speaking of, Hong Kong has been rolling out incentives to attract family offices to set up shop and invest in the city. And we spoke to the convener of the Harilala Group's Family Council earlier this week and asked whether more is needed.
So drawing money into Hong Kong is important, but how do we create the structure? How do we create the professional attributes that family offices, single family offices, as well as multi-family offices can attach to? The thing that's missing is really the software. And that's really the mental capacity, the professionalism, as well as the engagement and encouragement for foreigners to come in. Now, when I say foreigners, I also include China.
Let's bring in Christopher Hui, Secretary for Financial Services and the Treasury in Hong Kong, to talk more about all this. Christopher, as we heard from some of our prior guests, we are seeing, things picking up, but maybe more can be done in the way of attracting multi-family offices. What do you think, the landscape is looking like? What more should be done?
In fact, we are in a rather good state in terms of how we draw family offices to Hong Kong. Based on our survey done earlier, there are altogether 2,700 single family offices in Hong Kong, and not counting those multiple ones, because if you have multiple family offices, likely you need to get a license to operate that. But not counting that, we already have that number. That's number one. And number two, if you look at those 2,700, in terms of the AUM being managed, about half have assets over $50 million US. And that's why, in fact, this week is a rather eventful week for Hong Kong in a positive sense. We have named this like an investment week of the year because apart from the Wealth for Good Summit that we have for family offices hosted by the government, we also have HSBC doing the investment summit. We also have the World Economic Forum doing a green sustainability, green finance forum here. So indeed, along those lines, you can see that we are on all fronts in terms of how we can further enhance our role as a family office hub.
It's really going all out to court this family offices, and I think you've mentioned before that you're trying to introduce 200 by the end of the year. What sort of size and geographic location are they coming from?
First of all, in terms of reaching that target, we have absolute confidence because we are very likely to exceed that by the end of this year. If you look at the number that are already being lined up, around like 1/5 are those from Europeans. Because in this rather uncertain world, I would say, people do really see Hong Kong as an anchor of stability and predictability. And that's exactly what Hong Kong has to offer at this part of the world. And in that regard, we are very confident we can hit that target and all at the same time continue our drive to bring more family offices here.
Christopher, what are we seeing from kind of the nascent tech and AI sector? Are we seeing some of these sort of, newly minted funds and such being a bigger proportion of demand?
In fact, if you look at the demand for family offices, they come in multifold. First of all, many of them are interested in our stock market because right now, as you can see, our daily turnover now are reaching around $26 billion US, which has been a substantial increase as compared to last year. But of course, if you look at the other asset demand, they are also looking at like precious metals. And that's why we are now building a gold storage and also a gold trading center in Hong Kong, hopefully to draw that demand as well. And at the same time, if you look at a more new development of financial service sector, many of them are interested in virtual asset. And that's why the government will also soon issue a new policy statement of virtual asset in terms of how we adopt a more pro-growth strategy in this sector. And going forward, we also introduce more tax concessions for family offices along several dimensions. Number one is we are going to broaden the type of qualified or eligible transactions being allowed for family office tax transactions. Tax concessions. And in that regard, that will include private credit and also virtual asset and also carbon credit. And this is something that we'll put into law next year. And if effective and also pass into law, we'll hopefully to get it effective from 1st of April this year.
We've seen a number of measures from easing investment thresholds to tax breaks, which not only just apply to potential family offices, but also to PEs as well as, ultra high net worth individuals and even crypto investors. What are some of the other measures that we might see to try and counter competition from other cities? And at the same time, how does that sort of mesh with the need to expand revenue, obviously, and to plug the budget deficit?
I must say, if you look at the whole array of measures that we have provided for to draw family offices, basically it's along different dimensions. Number one, of course, tax concessions, as I just described, which we will continue to perfect. And number two is we have just launched a capital immigration scheme for people with 30 million Hong Kong dollars or more. We welcome them to Hong Kong as PR. And in that regard, the program has just been launched for slightly more than a year. And so far, we have already drawn about 900 applicants, at the same time drawing in around $4 billion to Hong Kong in terms of the assets being invested by these people. So you can see that along those lines, we are trying to use different measures in order to bring more high net worth individuals to Hong Kong. That's number one. And number two, I would say, if you look at the actual need of family offices or high net worth individuals, they are not just about money. They are also about lifestyle. They are also about how they can get a better living conditions. And that's exactly what Hong Kong has to offer. Because Hong Kong is actually an ecosystem where they can enjoy good food, they can enjoy good nature. We have more than 40 beaches. And at the same time, if you look at exactly how we build this ecosystem further, we're trying to make Hong Kong also a philanthropic hub, because many of this second and third generation, they are just not just looking for financial returns, but social returns.
It's a very enticing sort of ecosystem, Christopher, but I just wanted to ask you as well, because something that's sort of garnered a lot of attention is the CK Hutchison BlackRock deal. What are you seeing in terms of the tangible, perhaps psychological impact on bankers and lawyers in the financial services industry as well because of the deal?
As I said, Hong Kong is the anchor of stability and predictability for different parts of the world. And it has been the case before, it will continue to be the case going forward. And looking at the financial regulation, and at the same time, recently we are being named again third in terms of the Financial Center Index. And among them, we rank actually number one in investment management, in banking, and also financing. And all these underpin our stability in terms of offering sound financial regulation and also being an international financial center.
Do you think that perhaps when investors or bankers, lawyers are looking at this deal, that they might have to perhaps consider some of the national security overhangs going forward then, Christopher?
I think it's very obviously in the sense that after the enactment of national security law, what we have is stability, at the same time predictability in our business environment. Again, if you look at the rating of Hong Kong in this latest released Financial Center Index, among the areas that we've done well, apart from investment management, insurance and financing, we have done very well in terms of offering a very conducive business environment and also talent. And then these are areas exactly what Hong Kong has to offer. And at the same time, if you look at the other areas that we have outperformed, as compared to the index last year, we've outperformed in terms of climbing for 5 positions to number 4 in terms of fintech development. And that's exactly what Hong Kong has done well, and will continue to do so.
I think one example perhaps of, the dual-fold connection between Hong Kong and China is we've seen Beijing's reaction when it comes to the Panama Ports deal, right? Can you give us an insight into whether you think this deal will go through and how that potentially impacts sentiment depending on the influence that we see?
As I said, Hong Kong has thrived as being a financial center and also business hub. And legal and also law-abiding transactions would definitely carry on so long as they comply with the law. And secondly, if you look at how Hong Kong has thrived as an international financial center, the reason that people are willing to park their wealth into Hong Kong is to provide this stability and also predictability. As you can see from this week, when we have a very eventful week with many people from across the world coming to Hong Kong to explore new business opportunities, that's exactly what Hong Kong has to offer.
Stability, predictability, that's the message from you today. Christopher, thank you for coming in and sharing some of the plans with us. Christopher Hui is Secretary for Financial Services and the Treasury in Hong Kong. Coming up, our exclusive interview with the COO of China's top smartphone maker, Vivo. Hear about their ambitious overseas expansion plans next. This is Bloomberg.
China's top smartphone maker Vivo wants to increase sales from overseas markets to as much as 70% of their revenue in 2 years. The company's CEO Hu Baishan told us exclusively that subsidy efforts have done little to revive demand in China.
I think consumers' purchasing power only has impact on their phone replacement cycle. After China rolled out the subsidy scheme for smartphones in January this year, mobile phone sales during the Spring Festival indeed increased comparing to the same period last year. But after the Spring Festival, sales actually dropped. Why? The subsidies just simply moved up consumers' original plans for replacing mobile phones. It doesn't make fundamental change.
Given that you have risen now to the #1 position in China, ahead of Huawei, ahead of Apple for the full year 2024, what are your priorities to expand overseas? You've had some issues, I think, obviously in India. You've been beaten by your competitors in Thailand, Philippines, Vietnam. You've had some success in Indonesia, but you're not in the United States, Europe. What are your ambitions overseas?
First of all, the Chinese market has actually entered a typical stock market. The average replacement cycle of mobile phones in the Chinese market is about 4 years, which is about 280 million mobile phones sold each year. Although we are the #1, the difference among competitors are minor. Chinese market is still relatively competitive. For us, our future definitely lies in overseas markets.
What's your ambition for the U.S. market?
In fact, apart from the U.S. market, which we have not entered, we didn't enter other markets like Western Europe and Northern Europe, including countries like the UK, Sweden, and Norway. These markets have several common characteristics. First, a large proportion of users are Apple users. Second, they are mainly made up of higher-priced products, such as those priced at $800, $1,000, or above. Third, their telecom operators are dominated by large and powerful companies. At present, these countries are not a good match for us. So it's not that we're not entering the U.S. market. It's just that the time has not come yet. Maybe in 3 or 5 years, we may enter those markets with other innovative products, not solely relying on mobile phone products, to meet the needs of high-end users.
How directly impacted are you now, and do you expect to be, by the export controls on advanced tech, in particular the chips? Do you have to advance buy, stockpile these chips? How do you get around the geopolitics, which is across many technology industries?
We don't feel the impacts. For real. The disputes between China and the United States don't seem to affect us that much because, for example, Qualcomm and MediaTek are not affected. Memory chip makers like Samsung and SK Hynix are not affected either. So we don't feel the impacts. Essentially, for us, we operate within the scope of legal and regulatory compliance. We don't violate the laws of any country.
Vivo COO Hu Baishan is speaking exclusively with our Stephen Engel. Meantime, CATL has received approval from China to proceed with a share sale in Hong Kong, and the world's top EV battery maker says it has the green light to issue around 220 million shares. Bloomberg reporter Felipe Pacheco has been watching all this and joins us now. Felipe, why is this such an important part towards the offering?
Hi, April. I think this is quite important for both the issuer and for the market here in Hong Kong. We're talking about share issue sale of around $5 billion US. That's what our reporting has told us before. It's a secondary listing, so the company already trades in Shenzhen. There's been an expectation that this would come. This money is quite important for all of the expansion plans that CATL has within the EV battery market for this year. And then, of course, we need to look at Hong Kong right now. The moment for listings, for share sales, for IPOs has been a lot stronger than what we saw last year. For example, we had Xiaomi and also BYD coming to market over the past few days to sell new shares. And together they raised around $11 billion US. Demand has been quite strong. Performance has been good. So this is important to see that there is a continuation of this very positive trend.
What are the possible headwinds when it comes to the Hong Kong listing?
Well, Heidi, I think that it's inevitable for us to bring up the geopolitical factors that are also involved with this sale. Of course, this is a very big Chinese name. It's already listed, but it's in the mainland. It's in Shenzhen, in a mainland exchange. This offering here in Hong Kong gives access to a lot of international big foreign funds, but whether they will be actually willing to tap this, it's a different discussion. The company was added to a list by the U.S. Defense Department earlier this year with allegedly having links to the military in China, which is something that is not, the investors are not actually forbidden, U.S. investors, to actually touch those shares, but at the same time they could be discouraged. It's a decision that we will see once the sale hits the ground here in Hong Kong. Demand, as far as we can tell right now, our reporters also talking to bankers and to investors show that there is a lot of interest for these shares. So this is a quite meaningful deal, again, not just for Hong Kong, but for the industry in China and for foreign investors as well.
So significance for EVs as well as the Hong Kong fundraising in general. Felipe, Pacheco, thank you so much for sharing more on this developing story with us, and we'll have more ahead on the Asia trade. This is Bloomberg.
Take a look at some of the stocks we're watching as markets open up in Hong Kong and across mainland China as well. Tencent is one that we're watching with Huiyao, of course, backed by Tencent, pledging AI efforts as we see that slowdown when it comes to sales. We have been speaking a little bit about CATL there as well, getting that sign-off from Beijing to proceed with its Hong Kong share sale. So receiving that approval from the CSRC to issue up to 220 million shares in Hong Kong, potential fundraise of at least $5 billion. So really just adding to Hong Kong's recent surge in supersized share sales that we've seen of late. Over $15 billion have been raised so far this year. We're also watching Alibaba as well, with Ant Group signing a strategic cooperation agreement with the Zhejiang provincial government to collaborate on, you guessed it, AI, according to some local media reporting there as well. So continuing to see that AI and tech-driven focus. In China, this is a picture as we head into Taiwan trading as well. Pretty green across the board. This is Bloomberg.